You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. We are zeroing in today on why global markets seem to be, stuck in this really cautious holding pattern.
Yeah, it feels like they're caught between two opposing forces.
Exactly. On one hand, you have this surprisingly soft U.S. macro data, and on the other, this intense surge in geopolitical risk.
And it's coming from multiple directions, too. We're tracking everything from the Bank of Japan's currency signals to what OPEC Plus is doing with supply.
All while keeping an eye on, the escalating situations in places like Venezuela and Eastern Europe.
So today, we're going to try and identify what traders are actually waiting for. What's the catalyst that's going to break this stalemate?
Let's unpack it.
So that week U.S. Purchasing Managers Index, the PMI, that really set the tone early this week, didn't it?
It really did. Specifically, the Institute for Supply Management's manufacturing number.
Right. It showed deeper contractions in new orders and employment than a lot of people were anticipating.
And that just immediately reinforces that whole long-term narrative about the Federal Reserve, easing policy down the line.
It does, but what's so fascinating is how the currency markets reacted, or didn't react.
Right. The dollar pulled back a little, but it hasn't committed to a direction. It's just range-bound.
And I think what stands out is that everyone sort of believes the Federal Reserve will eventually ease, probably starting in 2026.
But because we're in that communication blackout period right now ahead of the next meeting,
there's no immediate guidance, and that's creating this paralysis.
That's the perfect word for it. It's conviction without a catalyst.
Exactly. So you see weak data, and it forces investors to price in a higher probability of those 2026 cuts.
But since you're not hearing anything new from the Federal Reserve governors themselves, no one is willing to, push the dollar decisively lower.
And so the dollar index just stays stuck in that range.
Now, if we look across the Atlantic, the euro seems pretty steady. It's just waiting for the Eurozone's flash consumer price index data.
And that's because the European Central Bank has been so consistent, so clear in its rhetoric. No major surprises expected there.
So the stability is just an expectation of no major data shock. But sterling the pound, that's a much more complex picture.
Oh, absolutely. It seemed to barely register any kind of lift, even with that announcement of the new zero-tariff pharmaceutical deal between the UK and the US.
Which on the surface should have been a political win for London, right?
Right.
An example of post-Brexit trade flexibility.
It should have been. But then you see the political and financial cost buried in the details.
The fact that the National Health Service might have to pay an estimated 25% more for new medicines.
That is a massive political liability, and it completely overshadows any potential economic benefit. The market sees that headline risk immediately.
So it's a perfect case study in how domestic political pricing can just completely negate any international economic gains.
It really is.
Okay, but the real drama this week, I think, has to be the Japanese yen.
Without a doubt. We saw the Bank of Japan Governor Ueda make those hawkish remarks. It briefly pushed the yen stronger.
Everyone got excited, hinting at a potential December rate hike.
But that momentum has just completely stalled. The dollar is already climbing back above that 155 mark against the yen.
So was that real, or was it just verbal intervention?
That is the multi-billion-dollar question, isn't it? Was the Bank of Japan truly signaling a policy shift, or was this just a tactical move to, manage the currency slide?
And that raises a really critical point about central bank credibility. If you signal a shift and then don't follow through, or the market just refuses to believe you.
Does that diminish your power to use those verbal cues in the future?
Exactly. This pause we're seeing suggests the market is deeply skeptical that the Bank of Japan is actually ready to follow up talk with real action.
And that skepticism is well-founded. I mean, Japan has maintained such extraordinary accommodation for so long. Any real move requires immense confidence.
So until we see hard data backing up a move, the yen is just going to stay sensitive to that yield differential with the U.S.
Which, in this holding pattern, continues to favor the dollar.
Okay, so sticking with the region. If we move toward the Pacific, the Antipodeans, the Aussie and New Zealand dollars, they seem to be following a pretty subdued script.
A slight upward bias, maybe, but traders are still trying to figure out Australia's mixed macro data. There's just no real conviction there.
The real anchor for the region, as always, comes from China. We saw the People's Bank of China deliver another weaker-than-expected yuan fix.
Yes, and what's fascinating there is the continuation of that signal. It's subtle, but it's a very potent policy move.
And what is it signaling exactly?
Well, a weaker fix shows a clear preference for supporting exports, which makes perfect sense given how sluggish China's domestic economy is.
So there's essentially sacrificing some currency strength to maintain their trade competitiveness.
Right. The long-term risk there, of course, is potential capital flight if domestic investors start seeing this persistent devaluation as official policy.
And on the actual trade front, we're seeing some really intriguing moves around a critical topic for global tech.
Yeah.
Rare earth magnets.
This is where you see business and politics get really interesting. Beijing has official export restrictions in place.
But reports are suggesting that producers are actually finding ways around those curbs to protect their sales channels in the West.
They are, because we're not just talking about any magnets. These are neodymium magnets. They're essential components in everything from electric vehicle motors to wind turbines
And defense system.
and high-end defense systems. So the official rules are about geopolitical leverage, but the commercial players, they realize that if they completely cut off their Western customers,
Those customers will just find another supplier.
they'll find long-term alternatives in Australia or Vietnam, and that market share is gone for good.
So they're using subsidiaries or transshipment points, just trying to fly under the radar of Beijing's official rules to keep the revenue flowing.
It just highlights that inherent tension between state-level strategy and the reality of global trade.
And speaking of calibrating relations, we also saw the European Union withdraw its World Trade Organization complaint against China over Lithuania.
Which hints at, a modest but important diplomatic attempt to de-escalate things.
Meanwhile, the UK, under its new leadership, is actually urging businesses to boost trade with China, despite the security risks.
It just shows you the tightrope that London is trying to walk. You can't fully separate economics from geopolitics.
Let's shift over to the commodity complex. After that notable rally on Monday, oil markets are taking a bit of a breather.
They are. Both Brent and West Texas Intermediate have cooled off, but there are two major factors providing a really clear geopolitical floor for crude prices.
First is OPEC+.
Right. We got confirmation they will maintain their current output levels all the way through the first quarter of 2026.
So that removes a huge chunk of uncertainty about supply surges. It reinforces that supply discipline for the long haul.
And second, of course, is the ongoing conflict in Ukraine, which just keeps that geopolitical risk premium elevated.
And let's be clear about that geopolitical floor. It isn't just about volatility. It's a resistance to any kind of sharp sell-off.
That's a great way to put it. Ukraine's persistent targeting of Russian oil infrastructure. It doesn't necessarily hit immediate global supply.
But it removes Russian production reliability from the equation. So you get this permanent risk premium just baked into the price of crude.
And that's what's preventing a rapid decline in the market, even with some of those softer global demand signals.
We also saw metals cool off a bit. Copper pulled back from last week's near all-time peak.
And gold briefly slipped below, what was it, $4,200 an ounce?
Yes, in some quiet overnight action. But that dip is likely just a marginal response to the broader risk tone stabilizing a little bit.
Critically, though, gold is still near incredibly elevated levels. And if you connect that to the bigger picture,
Gold's resilience is a direct reflection of that ongoing geopolitical uncertainty, combined with the softening U.S. macro data we started with.
it's the ultimate hedge. It's doing double duty against both inflation risk and the possibility of a global slowdown.
And that takes us directly to the three big geopolitical hotspots that are feeding this risk premium, starting with Ukraine.
Diplomacy is moving, at least on the surface. We had President Macron reinforcing the need for credible security guarantees for Kiev in his recent talks with President Trump.
And while that diplomatic chatter is positive, the conflict itself remains brutally active.
Oh, absolutely. Russia and Ukraine are still exchanging strikes. And crucially, the European Commission just warned that the border situation with Belarus is deteriorating.
Prompting consideration of more sanctions. So the pressure on Eastern European stability is actually increasing, not receding.
And just as a reminder of the strategic alignment here, we're seeing continued high-level communication between Moscow and Beijing. Russian Foreign Minister Lavrov met with China's Wang Yi today.
The second major hotspot is Venezuela. And the urgency here is ramping up dramatically.
It all stems from that critical missed deadline. Caracas reportedly asked Washington for sanctions relief for over 100 officials.
But the U.S. government gave them a firm deadline to complete a political transition, a deadline that has now been missed.
And that missed deadline is why the White House is preparing a high-level response. The president is meeting with his national security team.
So for markets, The critical element here is the potential reinstatement of sanctions against the state oil company, PDVSA.
If those sanctions come back, it could sharply reduce the flow of Venezuelan heavy sour crude to global markets.
And even a marginal disruption, especially of that specific type of crude, can send real ripples through the energy complex.
And finally, we have that ongoing sort of low-level tension in the Asia-Pacific. China's Coast Guard claiming it expelled a Japanese vessel near the disputed Senkaku Islands.
That's a flashpoint with a long history. It just serves as a reminder that these territorial disputes are a live, unhedged risk for regional stability.
So when you add it all up, risk sentiment is cautious, but it's stable for now. U.S. equities closed Monday lower, and futures are pointing to a muted opening.
So looking ahead, traders are waiting for a few key data points to break this stalemate.
Chief among them, I think, are the Eurozone's flash consumer price index, some supply announcements from the UK and Germany,
And the official release of the Bank of England's Financial Stability Report.
but without a major data catalyst right now, it really is geopolitics and those controlled commodity flows that are dominating the overall market tone.
It's a global holding pattern, just waiting for inflation data and central bank signals to provide the next clear direction. But the question you should be asking yourself is, can central banks afford to wait for the data? Or will the sheer complexity of all these overlapping geopolitical risks force their hands before the economic picture is really clear?
That covers the major drivers shaping market sentiment today, from the tactical actions of the Bank of Japan to the escalating situation around Venezuela and the European Union's borders. We truly appreciate you tuning in for this essential market update.
Thanks for being here. Join us again next time on the Financial Source Podcast for more critical analysis of the global economy.